Assalamualaikum and good morning everyone. My name is Nurul Aina binti Rashid. So today we are going to present our financial planning. I will start with introduction to financial planning. Financial planning is important because it helps individuals manage their income, meet current financial needs, and achieve future goals. In today's complex economic environment, people must make informed decisions about spending, saving, investing, risk protection, and retirement planning. Financial planning is a structured process of managing financial resources to achieve life goals through proper planning and monitoring. According to German and Ford, this process helps individuals organize their finances systematically. In addition, Kapoor, Dlabe, and Hughes state that effective financial planning improves financial stability, reduces excessive debt, and supports long-term wealth building. In this assignment, we apply financial planning concepts to Sally, a newly employed executive working in Bukit Jalil, Kuala Lumpur. As she has just started her career, she faces various financial responsibilities and future goals. Therefore, this financial plan focuses on managing Sally's monthly cash flow, including savings, housing, transportation, protection plans, investment, and retirement planning to ensure her long-term financial well-being.
Good day everyone. Today I will be presenting Sally monthly budget allocation and how she can manage her finances effectively as a young working professional. Firstly, Sally earns a monthly salary of 3,750. She is required to contribute 11% of her salary to the Employees Provident Fund, which is EPF, which amounts to 412.50 cents. In addition, Sally also need to pay monthly income tax, which we estimate to be around 55 ringgit. After deducting both EPF and tax, Sally net monthly income is approximately 3,290.50 cents. From this amount, Sally needs to carefully allocate her income to meet her needs, saving, and future goals. One of the most important part of financial planning is building an emergency fund. Emergencies such as job loss, medical expenses, or urgent travel can happen unexpectedly. By having emergency savings, Sally will not need to rely on loans or financial help from others. It is recommended that Sally save 10% of her net income, which is about 330 per month. With consistent saving, she can aim to accumulate between 9,000 and 12,000 within approximately 3 years. This money should be kept in a high-interest savings account to ensure safety and some return. Next, Sally has a student loan commitment of 50 ringgit per month. This is a fixed and compulsory expenses that must be paid on time to avoid penalties. Although 50 ringgit is a minimum amount, Sally may choose to pay more in the future if she has surplus income or receive a bonus, which can help her settle the loan faster. Sally plans to get married in the next 2 years, so early preparation is important. By saving 300 ringgit per month, Sally can accumulate 7,200 over 24 months. While this may not be a large amount, it is sufficient for a simple and meaningful wedding. It is also recommended that she keeps this money in a separate saving account to avoid accidentally spending it. Sally may also allocate 200 ringgit per month as an allowance for her parents. This amount is reasonable based on her current income and allow her to fulfill her responsibility as a daughter without overburdening herself. If she faces financial difficulties, this amount can be adjusted and it may be increased in the future for her income when her income improves. Next, for food and groceries are essential monthly expenses. Sally can allocate about 600 ringgit per month for this category, which average to about 20 ringgit per day. To save costs, she is encouraged to cook at home and shop for her grocery at affordable stores such as Mydin or Speedmart. Home cooked meals are not only cheaper but also healthier. Next, for utilities and communication, finally, Sally can allocate around 150 ringgit per month for utilities and communication expenses. This included electricity, water and waste management, especially if she lives in a share house. She is encouraged to practice energy saving habits and use energy efficient appliances. For communication, Sally can choose affordable prepaid plans such as CelcomDigi prepaid packages, which provide sufficient data and calls at a lower cost.
Hi, Assalamualaikum. My name is Nur Alia binti Ahmad Sharif. So, I will be suggesting a place for Sally to stay in Kuala Lumpur. So, Sally got several options whether she should rent a house, rent a room, or buy a house. So, to begin our housing recommendation for Sally, we must look at her current financial profile. Sally is a new joiner in the workforce with a net monthly income of Rm3,287.50. So her immediate priorities should include managing an education loan, navigating life without personal transport, and planning for her marriage within the next 2 years. Given these factors, we have conducted a comparative analysis to determine if she should rent her house, rent a room, or buy a property. Looking at this comparison table, we evaluate 3 options based on cost, flexibility, and lifestyle. Buying a house is deemed not recommended due to the very high 30-year commitment and upfront costs that conflict with her short-term marriage plans. So renting a house offers privacy but would consume 30% to 50% of her income, making it financially stressful. But renting a room emerged as the highly recommended choice because it offers a lowest monthly cost, only 12% to 20% of her income, and provides the very high financial flexibility she needs to save for her future. So, our primary recommendation is that Sally rent a room with a budget of RM400 to RM650 per month. This strategic decision minimizes her expenses and maximizes her savings. While renting an entire property offers more privacy, it is not cost-effective in areas like Bukit Jalil. So, by choosing a room, she maintains the flexibility required for her upcoming transition into married life. We have identified a specific suitable option, a room at Sfera Residency in Seri Kembangan, managed by Witopia Co-Living. At $600 per month, it fits perfectly within her budget. The location is highly strategic, offering direct access to the Putra Pemat MRT station, a public transport. It is crucial since Sally does not own a car. So the rental includes a high-speed Wi-Fi, weekly cleaning, and access to a gym and a pool. So it is effectively balancing cost, convenience, and her 2-year financial goals. That is from me. I will pass to the next presenter.
Public transport is the most economical and efficient option for Sally, particularly because her workplace is located near an LRT station. Kuala Lumpur's public transport system is mainly operated by Rapid KL, which integrates LRT, MRT, monorail, and bus services into a single network. This integration allows smooth and convenient travel across the city without the need for personal vehicle ownership. By subscribing to the My50 Unlimited Travel Pass, Sally will only need to spend RM50 per month for unlimited travel on LRT, MRT, monorail, and Rapid KL bus services. This significantly reduces her monthly transportation expenses compared to owning a private vehicle. The inclusion of bus services improves Sally's first and last mile connectivity. For example, buses can be used to travel from her rented house to the nearest LRT station or to destinations that are not directly served by rail lines. Public buses are frequent, affordable, and widely available in residential areas, which reduces the need for personal transport and makes daily commuting more flexible and convenient. Using public transport eliminates car-related costs such as petrol, road tax, parking, maintenance, insurance, and tolls. It also reduces exposure to traffic congestion and accident risk while supporting environmentally sustainable living. Overall, public transport allows Sally to maximize her savings and prepare for future goals such as marriage and vehicle ownership. Another possible option is purchasing a motorcycle such as the Honda Wave 125. Motorcycles are often considered cost-effective due to their lower purchase price and fuel consumption. However, this option will still involve monthly installments, petrol costs, insurance, road tax, and maintenance, bringing the total monthly cost to approximately RM345. Although motorcycle ownership is cheaper than owning a car, it exposes riders to heightened safety risks and unpredictable weather conditions. Given that efficient public transport is readily available, purchasing a motorcycle at this stage may not be the most financially wise or safest decision for Sally. Owning a car provides the highest level of comfort and convenience, but also involves the greatest financial commitment. A commonly recommended first car for young executives is the Product Asia due to its affordability and fuel efficiency. However, when monthly installments and additional costs such as petrol, insurance, maintenance, parking, and tolls are included, the total monthly cost rises to around RM870. This level of expenditure would significantly reduce Sally's ability to save and may lead to financial stress, especially considering her plan to get married within the next 2 years. Therefore, car ownership is not recommended at this stage of her career. To maintain convenience, Sally may still allocate around RM100 per month for occasional e-hailing services such as Grab. These services are useful during late hours, emergencies, or unexpected situations. However, e-hailing should only be used as a supplementary option rather than a primary mode of transport. In conclusion, Sally is strongly advised to rely on public transport as her primary mode of transportation. This approach promotes financial stability, supports long-term savings, and aligns with her future plans. Motorcycle and car ownership can be reconsidered later when her financial position becomes more stable.
My name is Nurul Aina binti Rashid. Next, I will explain the basic meaning of insurance and takaful. Insurance is a conventional protection system where risk is transferred from the individual to the insurance company. The relationship is a buyer and seller relationship where the policyholder pays a premium in exchange for protection. The insurance company owns the fund and keeps the profit. However, conventional insurance may involve interest and uncertainty. On the other hand, takaful is based on mutual help among participants. The risk is shared, not transferred. Participants contribute to a common fund through a donation called tabarruj. The fund belongs to the participant and takaful follows Sharia principles. Next, I will highlight the key differences between insurance and takaful. First, in terms of risk, insurance focuses on risk transfer, while takaful focuses on risk sharing among participants. Next, for fund ownership, insurance funds belongs to the insurance company, but in takaful, the fund belongs to the participants. In terms of investment, insurance may invest in non-halal assets, while takaful only invests in halal and Sharia-compliant assets. Lastly, any surplus in insurance is kept by the company, where in takaful, the surplus is shared with participants or donated to charity. For Sally, the recommended option is a standalone medical takaful from AIA Public Takaful called a Life Mediflag I under Plan 180. Under this plan, Sally is covered up to RM180,000 per year for eligible inpatient hospital expenses. This includes hospital room and board, surgery, doctor's fee, and inpatient treatment. The plan also includes cost-saving features. First, there is a 500 deductible, which means Sally pays the first RM500 when she is admitted to the hospital. After that, the medical plan covers the remaining eligible expenses up to RM180,000. In addition, there is a 5% co-takaful. This means Sally pays 5% of the hospital bill, while the plan pays 95%. Her total core takaful pays is capped at RM20,000 per year. This cost-sharing feature helped reduce her monthly contribution, making the plan more affordable while still providing strong medical protection.
Okay, my name is Nordania binti Azahai. So now I will present the investment recommendation for Sally. So let's look the strategy investment plan for Sally. So given her a current profile as a fresh graduate with a multiple commitments like educational loans and welding goals in 2 years, so we recommend Amanah Saham Bumi Putra ASB as her primary investment vehicle. So the foundation of this choice is safety and accessibility. So ASB provide a complete capital protection. So because units are fixed at RM1 ringgit, Sally never has to worry about the market value of her saving dropping. So combined with a high liquidity, this ensures that her money is not just growing, but is also available whenever she needs to pay for her wedding, vendor, or handle unforeseen expenses. Our specific plan involves an allocation of RM 250 cents per month. So this is roughly 6% of her salary, making it a painless investment that fits perfectly alongside her EPF and loan repayments. So this is a disciplined 2-year strategy designed to build her welding fund without requiring her to be a market expert of spending time monitoring stock price. To summarize, why we recommend ASB over a typical bank's unit trust, let's look at this comparison. So, the biggest factor for Sally is a capital protections. In ASB, her money will never drop below RM1 ringgit purchase price. So, in contrast, unit trusts are market driven. If the market dips right when Sally needs to pay for her welding, she could actually lose money. Furthermore, ASB has a zero upfront fee. When Sally invests RM200, all 200 goes into her account. So, most unit trusts charge a 3% to 5% sales fee, meaning her invest will start in the rate. So, sometimes a fresh graduate should avoid. So, in conclusion, Sally financial plan must be realistic. So, ASB provide the best balance of safety, accessibility, and steady growth. So, it's helping her reach her RM 250 monthly goal effortlessly. So, by choosing ASB, Sally is not just saving for welding. She is built a foundation of finance security. So, that will serve her throughout her career. So now I will explain the plans for Sally for their retirement. So to start, Sally plan follow a simple idea, balancing her life today with her needs tomorrow. So since she is just starting her career, she has 2 main jobs. First, she needs to pay off debits like her RM 50 ringgit education loan. Second, she needs to start build a money pot for the future. So build by saving a small part of RM 3,750 for their salary now. So her money has more time to grow through interest. This ensures that when she eventually stop working, she will still have enough money to live comfortably without any stress. So first, let's look at a Sally monetary EPF contribution. Since May 2024, the structure has changed to provide more flexibility. Sally 11% contribution, which is RM 412 ringgit 50 cents, is combined with her employer 30% contribution. So these funds are now split into 3 specific accounts. So first account is 75%. Is located for her retirement account. So 50% goes into her well-being account for things like housing or medical costs.
And lastly, 10% is placed in her flexible account. This flexible account is a key update as it allows her to make withdrawal of at least RM50% whenever she has an immediately financial needs. Ensure her money is not entirely locked away. To truly secure her future, we recommend Sally treat volunteer contribution as a booster energy by editing just RM50 to 100 a monthly through a iAccount apps. She can automate her saving discipline. So, even a small 100 monthly top-up can grow to over 120,000 by age 60 due to EPF strong 5% to 6% annual dividends. So it's very important to understand that why her emergency funds safeguard her current stability. This volunteer contribution build her future independence. By combining her regular 900 monthly contribution with this optional top-up, she will easily access the EPF basic target of 330,000. Systematic approach ensures she is ready for life bigger events like marriage while remaining financial self-sufficient. So next, I will pass to the next presenter.